with us here on Market Guru. Joining us today, Chakri Lokapriya, CIO and MD at TCG Advisory. Chakri, thanks for being with us.
Thank you. Pleasure.
It's a sea of red. It's looking incredibly gloomy. Help us find a silver lining if there is one at all, Chakri.
Well, I think there are 2 or 3 things happening around the world. One is China, second is the US, and third is oil prices. And China last year was growing at 7%.
Yeah.
And they thought there was going to be a hard landing this year. But China is in the process of transitioning itself from a manufacturing to a services-oriented economy. Services is today growing at 7%. Manufacturing is slowing down to 5%.
Right.
So overall, the economy will go to 5 to 6%. In this transition, there's bound to be some amount of volatility of data. So China is largely not the doom and gloom, but is going to grow at 5 or 6%. Second is US. US is growing really strong and growing without inflation.
Right.
So there is no real reason why the Fed should increase interest rates. And so we firmly believe that the Fed is unlikely to increase interest rates anytime soon. Maybe it's end of the year phenomena at best. And the third is all the major economies in the world, the US, China, EU, and even large countries like India, are commodity and oil importers, and they benefit from lower oil prices.
Right.
So while oil eventually will find its price, which we think is probably will hit a lower price but eventually settle around $40, $50, I think March is an important time when we'll see a volatility coming to an end.
Okay, so watch out for March. There's
March,
just a couple of months to go. Okay, so on the upside, I mean, the fact that the big question of valuations, we're seeing a lot of these stocks taking quite a bit of a hammering. Earnings haven't been inspiring, but some have managed to operationally stay stable. Do you see value emerging, or do you feel that things are actually just getting worse than they possibly should?
I think that's a good question, because if you look at Nifty as an index, maybe 25–30% of the index is either commodity, government-owned companies, where we are unlikely to see any kind of earnings revival.
Yeah.
And so and therefore the earnings growth for that index will therefore look weak. And with all the commodity fall, we'll probably still see downgrades for FY16.
Right.
But we should be looking at ex-commodity, ex-government-owned companies, and the balanced companies should actually benefit from the commodity fall and the oil fall. And so we think that the market is pretty much close to its bottom at current levels after today's fall, and hope by the second half of this year, as the benefits of these lower prices, I think we will see a revival of earnings for the Nifty and beyond.
Okay. So you're really saying that people should hang in there at this point. You know, that a lot of people have been sitting on cash because they've been worried about investing when markets are looking so jittery. What would be the strategy you would advise? Would you still get in at these lower levels if you're already invested? A lot of people are actually just crying right now. You said that, okay, you know, things will just hang in there. But for others, would you say sit on cash, or would you still say get in?
I think hang in there is the right attitude, simply because after 2008, 2009 was a phenomenal year for the Indian equities, where you delivered 70 to 100% returns. And the market is pretty much, in terms of valuation and bottoming out, pretty much where it was in 2008. So I think if we can hang in there with this current volatility, we'll benefit from a very strong later half of 16 and 17.
Okay, so would you buy right now? I'm going to pin you down on this. Would you be putting more money in right now? Or would you wait till, as you said, March or even mid-year?
Indeed, indeed. We are buyers at current levels, but we're staying away from some of the banking sectors and some of the metals. But other than that, we are buyers.
But, you know, Chakri, tell me this. When you've got banking and metals, which make up such a huge part of the index, right? And then you're just having no support coming in from IT or even oil and gas. You know, we had that brief period when we at least saw an RIL, you know, pulling the market forward. Don't you worry that in the immediate term, we're pretty much going to see the bottom fall out of this market?
I think it's now time to look beyond the Nifty for the simple reason there are 7,000 odd companies listed in this country. And The Nifty, as we discussed earlier, 25–30% is all commodity owned. If you look at the current earnings trend, actually the large caps have been disappointing more than the mid caps. And ex-metals, ex-PSU, maybe 55% of the companies that have reported so far have actually met or beat estimates.
Right.
So in this environment, so there are enough number of companies to look at.
Right.
And India's net, you mentioned about oil and metals, is net an importer of commodities.
Yeah.
So if you take out some of these metal companies, I think there's enough growth in the non-metal, non-oil areas.
Yeah, okay, but when we're taking a look at the broader markets, sentiment seems to hit them first. So even if we've had decent earnings, the stocks, in fact, are still taking a battering. Most people tending to stay away from mid-cap. So would you actually have a contra view there and say no, go into some of those stocks?
Indeed. In fact, it's actually quite revealing to look at the data that big caps have missed much more as a percentage versus mid cap in the current earnings. And second, it's always been mid caps sentimentally has been more riskier and all that, but the valuations today are really sound. So I think it is time to go in and buy mid caps, and there is lots of opportunity out there.
Let's take a look at what we're watching today. The IT space is seeing a complete knock on, again, sentiment. You're just smiling.
Yeah.
But it's really worrying to see. I mean, it's not entirely unexpected. We have been seeing even the domestic majors signal that things are going to be a little slower. But let me get your view in on the IT pack at this point of time.
I think today is largely a cognizant phenomena, and they have been, I would assume, cautious given the current volatility that we are seeing out there. Their guidance is actually not that bad if you sit back and look at it.
It's just that it's cognizant,
it's just because
they never ever have a slower guide.
Indeed, indeed. And I think US is still fine, even if you look through EU is recovering. And these two are the major markets for Indian IT. So from that perspective, I think today is just a part of the overall sentiment. But the outlook is still pretty strong for Indian IT.
Okay, so basically there's a lot of red in the screen, and I'm trying to get a gloomy picture from Chakri, but it's not happening.
No.
He's saying just hang in there, and things will start to sort of settle down at this point of time. Okay, so in terms of what we can look at in terms of the other sectors, you mentioned stay away from banks. We still haven't seen the major PSU earnings come out yet, and we've got banks still crying about performance in terms of liquidity crunch and so forth. The RBI, not being able to pass on, all of those, rate cuts as well. Again, how deep do you feel the problem goes? Because is there a lot more pain to come? Have we seen the worst over? I mean, it's an important question because it really has a lot of weightage, as you know, on the index, and seems to sort of indicate trend going forward.
I think these are all good questions, and the RBI is doing a phenomenal job in giving a March 2017 deadline, and also nudging banks to recognize certain groups of accounts, even if they're not technically NPAs today. And so I think that is a very important thing, positive development happening. And second, I think it's time that the government actually puts in the capital, recapitalize the banks, and take out the bad loans, the NPAs and potential NPAs. That is the need of the hour, simply because credit growth depends upon a bank's health. And banks are today constrained by these bad loans. So I think more than anything else, we need to see a resolution of taking out of the NPAs and going into 2017, March 2017, that's the deadline given by RBI. I think this 250,000, 300,000 crores of NPAs can pretty much be solved. And we are pretty much there. If you look at the NPAs today, they are probably higher than the NPAs in 2008.
Okay. So fair enough. So in terms of the kind of leverage we're seeing across some of these companies as well, and the kind of exposure banks have to them, I mean, you said earlier just leave those out. But what happens to people who are actually invested in those companies? I mean, is it just really a story that you would forget about?
Partly yes.
Yes. So you would say cut your losses, get out of it.
Indeed. And And that's what is a portfolio approach, is on an average, you even out. And yes, some of those groups are really leveraged out there.
Okay, so give me a sense in terms of your overall portfolio then, Chakri, right now, what else you would be overweight or underweight on, how the overall picture is looking?
Well, from now you must have guessed that we are underweight.
Yes.
We don't own any metals, no oil. We own refining, no PSU banks, and no banks in general.
Right.
We are strong on all the export-related sectors and beneficiaries of various commodity beneficiaries, including infra. And so we have a cyclical stance. And consumer, we think both urban and rural, if there's a normal monsoon, should see a revival. And so that's largely the stance.
Okay, so let's take some of those one by one. Consumer that you mentioned as well. Where does that positivity come from? We've seen absolutely no traction on some of those names. The monsoon's still a while away. In the latest GDP figures, we're still seeing difficulty on the rural side. So what makes you positive?
Urban today has expanded beyond the tier 1. So there's this tier 2, tier 3, who have all become urban. And the services part of the economy is actually doing fine.
Right.
So we're seeing a revival over there. Second, as far as the rural is concerned, you've had 2 bad years of drought in a row. It is statistically not easy to have a third drought in a row, but nature being nature, who knows. But I think there is some amount of positivity because you're bottomed out as far as the rural bit is concerned. So I think net, I think the consumer today is expanded, the base of consumer. And that is, and there's greater income because of the services sector.
Okay, so still bullish on that. In terms of exports as well, again, wouldn't you want to focus on the domestic story versus the export story, or do you still see enough traction in US and Europe at this point that you feel exports are actually going to be a good bet?
India is primarily, fortunately, a domestic economy and a services economy. So when you have 80% plus of your GDP growth coming from domestics, then it's less immune to these export-oriented bits. And fortunately, the export-oriented bits for India is IT, pharma, textiles. And these are very resilient. People fall sick all the time, so they need pharma. And IT is an essential bit, and the work at least that India does. So I think just the domestic revival is enough for India's GDP to actually bottom out and accelerate.
Okay, so on the back of the domestic revival, what are some of the are there other smaller themes also that you're looking at? You mentioned, consumption as well. So would you be looking at, for instance, retail or aviation, or, what else in terms of the mid-cap area or the broader markets are you identifying as possible themes going forward?
Each segment has a number of bits that will benefit. For instance, industrials, they will benefit from lower input costs, lower steel costs, lower metal costs in building their factories and bridges and roads. Commodity prices, so paints, adhesives, they'll benefit. Car manufacturers benefit because of lower steel prices, aluminum prices. Services companies benefit from lower freight costs. So there is a fair, decently big segment of sectors that will actually benefit from this whole thing.
Okay, I guess the bigger question is, will that benefit be enough? I mean, in terms of it may be enough for an individual individual's investment strategy, but perhaps maybe not enough to lift the market, right?
From a Nifty perspective, I think for the reasons that we've discussed, 2016 we're unlikely to see any big revival, but in 2017, yes. Because as we bottom out, even the commodity packs, that would help. And we still believe that 2016, the Nifty would generate a 15%-ish kind of a return, which then means I think the mid-cap would deliver a higher return.
Okay, so just coming back to what you were saying about the exporters, you're actually saying that you're positive on them due to the resilience factor, regardless in terms of the sectors that they're in. But in terms of markets, you're actually seeing the domestic market turning out to be the one where you actually see growth.
Correct, indeed.
Okay, and on the consumption front, you said that as well as the base is increasing, services, etc. So which are some of the pockets? I don't know. I know you probably won't tell me specific stocks, but which are some of the kind of themes that you see playing out there? Because there are some that are perhaps very, very focused on rural, which is still slow. But you're focusing on a slightly different pocket of that consumption market.
Yeah, no, those are all good questions. Now, for instance, if you take petrochemicals as an area, plastics as a sector will benefit big time. And there are a number of areas of plastics. Auto ancillaries are moving away from metals and to using plastics as a raw material. Then you have all the chairs, tables, Neil Kamals of the world.
So you really got to go out there and find these ideas,
you
right?
have to go out and find them.
That's why we're talking to you.
And there are more than enough pockets. So not just ideas, they're broad enough sectors.
Got it. That are usually...
That will benefit from this whole volatility in the market.
So when you were talking about returns and mid-caps outperforming, as you were giving that year-ahead target, what are the kind of returns we can look forward to, both on the index and mid-caps? Because as you said, you're going to see some of these outperform. What are the kind of returns you're looking at?
From a Nifty perspective, I think it's an easy 15% plus, around the 15% mark. And from current levels.
You're still saying 15?
Still saying 15. And more a second half phenomena once we go through the next couple of months. And mid-caps, earnings growth, I believe, will be stronger for 2017. And markets being forward-looking, I think it'll probably be 15 to 20% kind of a thing.
Okay, so I get the strategy here, and also just to keep in mind once again what Chakri was saying earlier about the entire commodity space and how some of that benefit is going to pass on to some of these pockets of the market, particularly on the oil front. Stay away, however, from metals and banks and over-leveraged sectors altogether. I still have to ask you on infra, but before I do that, to what extent do you feel markets have factored in anything we may see out of the budget? Is that going to be a significant factor this year?
I think the budget, as RBI has kind of indicated, needs to focus on fiscal discipline.
Okay.
As long as your fiscal deficit and current account deficit are in order, I mean, we don't miss the targets, or the targets are not missed, then the rupee depreciation is largely done. And I think that no new taxes. The market talks about taxes in various sub-pockets, which will be taken negatively. So as long as there's a fiscal discipline and there are no new taxes, we don't need big bang reforms like GST, which is unlikely to happen in this budget, in our opinion. I think we'll still largely be fine.
Okay, but in terms of the fiscal deficit as well, isn't there a case for further spending at the risk of perhaps overshooting that fiscal deficit?
As long as it's productive spending, that's fine.
Okay.
Building more bridges and dams, using the MREGA to build bridges and dams, employing that labor, that is productive. And you actually going ahead and making the SUTI, the SUTI sale, actually doing it is useful. So I think there's enough levers out there, but this time has come for them to actually...
Are you expecting a lot for the infra space in the budget? And it's interesting because you highlighted infra earlier, and we're starting to see a build-up on order books. But if you're talking about leverage, a lot of these companies are still feeling the pinch. So again, why the positive outlook?
Infra one, even though you might not see a top-line growth, you would see a margin expansion because the input cost has come down a lot, the metal cost. And end of the day, profit margins are important, and it'll also benefit the companies from better cash flows. So even if there's a marginal uptick and completing the stalled projects, that's sufficient to carry us forward for the next 2 years, not necessarily new projects.